Hello and welcome to another episode of the Truth About Real Estate Investing Show. This week we have on superstar real estate accountant extraordinaire. I know she's extraordinary as I've stress tested her myself with my outrageous tax questions. Can I deduct? Fill in the blank a million different ways. And she's CFO to our own 8-figure investment portfolio of both residential and commercial holdings, not to mention our 4 businesses and 1 registered charity. Those are each a corporation as well. All you single accountants out there, know that you are a hot commodity. Everyone else, you don't know the benefits of an in-home CFO into the one who understands your books, does your accounting for cheap, takes your calls from the CRA on your behalf, and applies for all your mortgages and refinances. I literally took a call from the CRA this week while standing in Cherry's office on speakerphone so she could feed me all the answers. Not to mention she's an amazing mother to our 2 kids, Robin and Bruce. I gave the kids silliness. Cherry is the disciplinarian and the loving one, hence she's responsible for all the compliments that we get for what great kids they are. For example, she's the one that got them to eat vegetables thanks to some early, well-timed yelling. Yeah, straight up, we've yelled at our kids. Not so much anymore, though. They're quite well behaved now, and they eat their veggies. So, right or wrong, something worked out. I'm the introverted one, while the kids have regular conversations with adults at adult parties that we bring them to. Yeah, our kids get invited to many functions where other kids are not invited, including their CrossFit class that they attend that's meant for teenagers. But the gym trainer and the owners believe that they're well behaved enough so they can, they're in a class with kids that are like 5-10 years older than them. I don't know where they got this from. Definitely wasn't for me. Please do allow me one proud parenting moment. My youngest, Bruce, he won King of the Mat at his Brazilian Jiu-Jitsu class. It's not that big a deal. It's a class of like 13. He's not the biggest though. But anyways, as you know, I'm a fan of hacks, as in like efficient shortcuts. So I've been teaching Bruce tactics to counter the trips and throws that his classmates are taught in class. So Bruce is countering what's taught in class, the moves that the kids practice, because that's what they're taught in class. I've been teaching him how to counter those trips and throws. And it worked out, specifically using single and double leg takedowns. Bruce successfully countered and took down each of his classmates, including his sister, Robin. I was super proud. But you can't win them all. My daughter unfortunately lost all of her sparring matches, so still much learning to be done for all parties, including myself. I think I could be a much better parenting coach all the time. No one said I was perfect. I'm definitely far from it. Speaking of hacks, as in efficient shortcuts, is now in how they pertain to wealth creation. This is the last call for tickets to the Wealth Hacker Conference, wealthhacker.ca. After this episode, I don't think I'll mention it ever again, at least for a while. Wealthhacker.ca for tickets. This event was the event of the year last time. Don't take it from me. Take it from the people who attended. They'll all be back for this time. And the entire community will be there as expected. You know, Rockstar, Keyspire, Rain, Rich Dad, Trust Your Talent, of course, I Win, all the other smaller groups that are out there, they will be there in force. Why? Because our investment community faces the greatest risks I've seen. I've never seen such widespread financial trouble. These times honestly make 2009 look like a blip for the context of a Canadian real estate investor. And there's more challenges coming. I'm hearing regular requests for private borrowing. I'm hearing from lawyers. I'm even receiving them myself in my email. I've never even advertised myself as a lender. So yeah, anyways, and these are people not investing, but they're looking for liquidity, as in they're trying to hang on to stay liquid, as they're not looking to sell. They're trying to avoid having to sell for losses. So it's tough out there, and it's only gonna get tougher. I expect at least 2 more interest rate increases, and for that reason, fear is high. The time for greed is soon. So you'll want to be learning from the best of the best experts. My friend and 6-time best-selling author, Derek Foster, who learned to invest while studying studying Warren Buffett. Derek is outperforming Warren Buffett's Berkshire Hathaway this year in 2022. Derek's up 5%. Berkshire Hathaway's about even on the year. and while the rest of the stock market's down 20 to 30%. So I want to learn from people who can completely beat the market. I think we all could benefit from that. Jordan Anderson is our leading crypto expert. He's likely the best crypto expert you can find in Canada to speak to the subject. And I think if you're a real estate investor, you understand the need for hard assets and how fiat currency is yuck. So you want to hear what Jordan Anderson has to say and how he's investing his own money. Jesse Itzler, our keynote speaker, if you Google him, he's worth well over $200 million, and he started from nothing. He used to sleep on his friends' couches because he had no money. He's almost been broke many times. Now he's worth over $200 million, and that has nothing to do with what being married to a billionaire. So he will be sharing how to overcome challenges and thrive in markets like these. Cherry Chan, real estate accountant, will be sharing how to retire faster with corporate structures so you can pay less tax. She'll have some advice, and because this is the time. Well, the time is upon us soon. Maybe even now, I don't know, to be investing more. Cherry and her accounting partners have been consolidating lessons from their experiences working with 500 plus real estate investor clients. And since no one hides anything from their accountant, real estate investors usually highlight their losses to their accountants so they can account for them properly, harvest tax losses. Accountants know the truth about real estate investing returns, losses, and more importantly, the path forward. Cherry's on the show today to share about the burning question. I'm asking her, well, actually, no, she told me what the burning questions are that she's getting from clients. They include tax implications of short-term rentals and AirBNBs, especially when selling, where clients lost money, and a lot of that was around not understanding the risks, setting up businesses and corporations specifically for investing in the United States. Please enjoy the show. I give you my lovely wife, Cherry Chan. Hey, Cherry Chan. What's keeping you busy these days?
Planning the Wealth Hacker Conference.
Why is that keeping you busy?
I know, you're taking on most of the work. I'm taking on most of the stress.
I think there's lots of stress and work to spread around. Why do we agree to do this?
Well, I think there is a need in the market, to be honest, to answer the question, what are we doing next? How are we going to survive this recession? And I think recently one of our clients sent in a question, and it just got me thinking, this is really the reason behind why we're doing Wealth Hacker Conference. How do I protect my investment income? Mm-hmm. I mean, this is pretty hard to answer. I don't know why this client thinks that the accountant, the boring accountant here, would be able to provide a solution to that question.
Because we didn't get everything right.
Yeah, but then the reality is that everyone is looking for a solution. And so that's the reason why we gather all these experts to help answer that question in the upcoming Wealth Hacker Conference.
I think that's the answer for today. When we planned the conference back in 2019, we planned that we would do the conference again back in 2019. We were not thinking we'd be in this situation, going through a global pandemic, pending, or we're already in a recession, economic winter. But that's what we're leading to now, because we're here to answer what the current today's problems are.
Yeah, well, I mean, I tell people, I have clients who come to my team and ask, is Cherry not doing accounting anymore? That's not true. I always tell people that I am a problem solver. Mm-hmm. I don't care if it's accounting, tax, or whether it is answering a question for a client, how to protect their investment income. That doesn't matter. I'm just out there to try to solve problem. And today we're seeing that problem, how to protect your investment, mm-hmm. how to protect your investment income as well. Mm-hmm. So those are the questions that we're trying to solve.
Because we're seeing, we're recording this October 20th. Again, we're in a recession, pending recession. Pretty much every investment category is down over the last 12 months. Mm-hmm. Stocks, crypto, real estate. Mm-hmm. Where should we start? Private lending is a hot topic these days. I'm hearing lots of pain out there. No one I know personally, at least not that I know of, no one's shared with me, but I keep hearing from other lawyers and mortgage people that there's a lot of pain out there from people who lent money and people who borrowed money mm-hmm. at high interest rates.
It's actually really sad. You see it on the news all the time. Like recently, I saw another news article that this older lady who wanted to invest in real estate signed up for a course that's hosted by someone in BC. And this lady, the course heavily promoted promissory note, so private lending. Without promissory note is essentially you sign a piece of paper saying I owe you to me and promise me to pay a certain amount to me, and that's it. And there is no backing, no underlying backing. There's no security.
Sometimes there are, often there isn't.
Yeah. So in that situation, the borrower went bankrupt. And the older lady was borrowing against the property to purchase to lend out the money. And now there's nothing.
So she borrowed from like her home?
Yeah.
So she's paying interest on that?
Yeah, exactly.
Only to lose the money?
I mean, within my clientele, I've heard problems from a few of our clients not being able to collect. Some clients are losing money on lending out, doing private lending.
Yeah.
Another client actually participated in this type of scheme. It's not really a scheme. I never really strategy. Like it's being promoted heavily by a lot of people on YouTube as well. I've seen a few of the videos.
Social media influencers, yeah.
And
which is the ideal place to go get quality information. I jest because we some people throw us in that category as well. But yeah, sorry.
Yeah. So like the strategy basically works like this. If you are like I'm the one that's borrowing, I'm lending money to you, and so you need, say $200,000 as the mortgage. You like the house is free and clear. You're just borrowing $200,000 from me. So I can structure that $200,000 loan. A portion of it is in my own name. The other portion of it is in the RSP's name, my own RSP, and then the last portion of it is in the TFSA account's name. So 3 portion, but it's the same, like total $200,000. But because they are trying to rank, they're trying to play around with the ranking of the debt. So for example, the money that would go to me, so my portion of the loan, my personal name, not in any registered account, is going to be ranked first. So by ranking first against your property that I'm lending money on, essentially I'm first, so I assume the lowest amount of risk. So it could be giving me 3%, 5% loan there. Right now it's at 5%. That's what the bank are going for. So let's say the first 50,000 is at 5% loan. I borrow from my line of credit to lend it to you, 5%, it clear, nothing happened. Now, and then the ranking sets the RSP that's ranked second would be ranked second.
Mm-hmm.
So
an RSP second mortgage.
RSP would be the second mortgage. Yeah. So over there, I'll lend you $100,000. And because it's ranked second, so the interest rate is higher, maybe 7%, 8%, because like CRA can, understand because you're ranking, the loan itself is ranked second, you earn high interest rate. And then the last portion is the TFSA. So TFSA account would lend you, say, another $50,000. That TFSA $50,000 loan, because it's the third mortgage on the property, it's assuming the highest amount of risk, and therefore you would give 15% on that TFSA third loan. So by doing this, what the ultimate goal of having this type of arrangement is that majority of the income is going to go to your TFSA account. And a lot of you would know the TFSA account has no tax on it. So when you withdraw money, when you're earning 15% on your $50,000 loan, you pay $0 tax. So this is a pretty good deal to redirect some of the income from your personal name all the way, and then from your potentially from your RSP name to the TFSA's account, and while you're still generating reasonable amount of income. So what happened with this type of structure is that when you fall through, if you are in some of our client's case, the borrower is not able to return the money. So what happened is that, let's say the property is $200,000. I lend 100% loan to value, $200,000. Now the property go down to $150,000. So when I take over the property and I sell the property in the open market, I'm only able to get $150,000.
You're simplifying the process. It's actually a pretty ugly process, but yes.
Yeah, so that
I've taken control of the property and all the cash outflows.
For sure.
Yes.
The $150,000 that you get back from selling the property, the first $50,000 is going to go to the first mortgage, which is then your unregistered personal one.
Yeah.
So your first one will be totally recovered. You don't have any.
Thank goodness.
Yeah. Now then the next $100,000 is gonna go into your RSP because it's based on the ranking of priority.
Yeah.
So then the $100,000 get that your RSP get back $100,000. Now then your TFSA also has the third mortgage, the $50,000 that we mentioned, but there is nothing going into the TFSA account. When TFSA accounts incur that $50,000 loss, there's nothing to write off against. That's it. It's gone forever. So you can't write it off as a capital loss in your personal name because of the ranking. Right. So when things go well, this type of strategy worked really well. But when things doesn't go well, as in the example like I mentioned, what's going to happen is that your TFSA account, the taxpayer's TFSA account, is going to absorb all the loss. You can't recoup any of the loss because TFSA account, there is no it's not taxable. The amount that you earn in the account is not taxable. The amount that you lose in the account is also not deductible.
Oh, crap.
So then you lose the contribution room, you lose whatever you accumulate there, you start from scratch.
You lose the contribution room too.
Well, you contributed that $50,000 somehow at some point.
But it's gone.
It's gone. The contribution room is gone.
Same with the RSP?
RSP is...
Your contribution room gone too?
If you lose money in the RSP, the contribution room is used up when it was done. It was used up. It's being used at the time when you contribute, not whether you take money out or not, or how the portfolio is performing.
Right. Mm-hmm. And so when you do take RSPs out, you're just taking out less. You never actually get to have a capital loss.
You don't have capital loss. You have less money to take out.
Oh.
Arguably, you would have made some money on the tax saving, right? Arguably. But that's how it works. So
that's not much. It's not much of a silver lining.
Those strategies don't work. Now, so for people who just lend money out directly using their own personal name, not using TFSA or RSP, if there is a loss incurred, you would be able to write it off likely as capital loss. Mm-hmm. You could potentially write it off as business loss, but it is a lot more strict in terms of rules being applied if you want to write it off as business loss.
Right, but in the case of the old lady in the article, not likely.
Yeah, exactly.
Sounds like just a person. Just sounds like an investment.
It will be more likely a capital loss, meaning the loss would only be able to be applied against capital gain that you make.
Wonderbar. So I know we're talking offline about private lending. My own thing about private lending is I don't personally want to do it because I don't want any more. We already have an exposure in real estate. I don't want more exposure to the real estate market. Mm-hmm. I don't know if everyone understands how to gauge risks.
I think the biggest challenge with people who have promissory note is because private lending, do private lending, is because they want to be able to make the high return and not really
understand their risk.
Or not really needing to lift a finger. Literally, the lender would don't need to pay for anything. So it's always the borrower who pay for the
lawyer.
Yeah. The borrower would pay for the
banking fees.
Yeah, the mortgage fees, the lending fees.
Now brokering fees too.
Yeah, the brokering fees, and then as well as probably the institution fees. All the fees are being borne by the borrower, whereas the lender really just show up at the legal office to sign. So a lot of people and clients are attracted to these type of deals because they're easy. And then you get like 10% return. Like, where else would you be able to do that by signing that away? But people don't usually do the level of due diligence. They only focus on the percentage return. They don't look at their risk tolerance. And that's where the biggest problem is. I personally have no problem with people investing in this type of strategy or investment vehicle. It's just that you have to understand that, hey, like if things go south, you have that risk.
Right.
And people don't focus on the risk side. They only look at the 10%, 15%, or 20% if it is promissory note.
Right. They don't understand the risks.
Yes, that's the problem.
Because ever since a friend of ours had their second, when the owner stopped paying the first, and they had to take over.
Yep.
Like, it's pretty painful. Like, it was, like, there was large legal fees. Like, it was over $10,000 in legal fees immediately that our friend had to pay, being the second, in order to take control of the property. And then also they had to start making the payments on the first mortgage.
Yep.
Right? That's not something I want to get into. We're not in a financial position to be taking on other people's mortgages. I don't know if everyone understands these things.
Yeah, like, so what happened in that particular property was that I actually have a YouTube video on it. So for anyone who wants to go on my YouTube channel, there is a video titled, I think, turning $50,000 losses to $100,000 or $200,000 gain. So what happened was that so our friend's mortgage was second to the lender, the A lender, A banking lender, bank,
a bank that everybody knows.
A bank, yes. So the borrower was not able to make any payment anymore without telling her. Yeah. So she's the second mortgage holder. So the bank is starting the foreclosure process,
including all the legal fees.
Exactly. And adding on all the fees that would otherwise be charged. And so now all of a sudden, the first mortgage, say $200,000, all of a sudden there's an additional $50,000 on fees being charged by the bank. And the property would be able to be sold for like maybe $300,000 minus all the fees, maybe net $250,000. So then there is no room to repay her own loan amount. The loan could be $50,000. So then what she did is to take over the entire property. And at closing, when she took over the property, the bank said that we can't sell it to you because the previous owner still owe us after paying all the fees and other $10,000.
So you have to pay it.
She had to, on top of the $50,000 loan that she had to actually pay another $10,000
to cover the owner's
shortage.
Yeah.
The fees being imposed by the bank. What people don't understand is that when you're ranked second and your loan to value is really high, there's nothing left realistically.
Yeah, after legal fees.
After legal fees. So what she did is she then turned around and then renovated that property and subsequently sell it for a lot higher in a few years, but not immediately.
Yeah, she held it for at least 3 years?
Yes.
Right. So the market saved her.
Yes, absolutely.
Right.
And it's not for everyone, right? Like, how many people are able to close the property and resell it for a profit?
Exactly.
Yeah.
Because a lot of people got into private lending because they didn't want to be landlords. Now here's someone who's forced to become a landlord.
Yes.
And take on a mortgage and take on... I forget who lived in the property as well, if there was a tenant or not.
That was a tenant to the previous owner.
Right. But so, to me, way too much risk for the return. Just me personally. Right.
Yeah, like everyone's investment priority is different. And there are options out there that could generate similar amounts of return or would give you similar amounts of return but with lower risk.
Yeah.
Like we mentioned, our Wealth Hacker Conference speaker, Derek Foster, he was on the show before. He talked about how he used the stock dividend portfolio to retire till today. I think those are a lot less risky compared to like doing...
Yeah, and truly passive.
Yeah. Exactly. So those are the options available, and which is why we are having this conference to present all the options available. There's not one answer to every single question.
There isn't, but we believe in people having options, and like our own investment plans for next year. Like we've talked about growing our dividend paying portfolio of stocks, and I can't think of anyone better to learn from than Derek Foster. Derek's actually up 3% this year. While the stock market's down 23%.
And so is the real estate market.
I don't even know where the real estate market is, but yeah, we're probably down somewhere around 23% too. But you know, we made some smart decisions last year. We didn't get everything perfect, but we locked in some mortgages. We refinanced a lot of them at the beginning of the year as well. Again, I kind of wish we sold some at the peak in order to have more cash. We didn't get everything perfect, but we did better than most.
We're very blessed.
Yeah, we're very blessed.
There's always something that in your life you can look at and whether we were able to sell it at the peak or we're losing money, we have some unrealized losses, we're still very blessed. We're still in the position to say that, hey, like we are still surviving. Like we have no financial problem, not on wood. We're doing okay.
Right.
We have no health problem. We're doing like way, way, way better.
Okay. I'll trust you that we're okay financially since you have all the books. And I just trust that you know that number.
Hopefully.
So before we start recording, we talked about other things you see your clients doing. We talked about like markets and stocks and crypto are all down. Like I don't know anyone who's really avoided that. That'd be accurate.
The stock market is down and we see losses in the tax reporting side, from the tax reporting side. But you also have to understand that tax reporting side, it's like 4 months later, so like, or maybe a year later. So we're seeing it in what we do, and we're seeing it from our clients' books. We're also seeing a lot of people investing in, or at least engaging us to start talking about structuring investing in the US. We also see a lot of our clients trying to increase the cash flow by renting out their properties via short-term rental.
Okay, you said a mouthful. Let's just move, before we move on from stocks and cryptos, for example. What is the tax treatment of losses? What do people do with those losses?
So, well, that is a great question.
For tax purposes, I mean.
Okay. So,
other than cry in bed at night.
So you're talking about private lending losses, or?
Yeah, let's handle each one. Private lending losses. How did they? Well, I think you already covered that.
Yeah, private lending losses. I already covered.
TFSA and RSP, you're just SOL.
Yes, there is nothing. You can't really claim anything.
Right.
If your private lending loss is incurred in your own name, you are the lender, and you lend it to small business, you might be able to claim something called allowable business investment loss. So you have to check, and CRA always do audit. The benefit of claiming allowable business investment loss is that even though it's only 50%, again, if you lost $100,000, only $50,000 is can be claimed. That $50,000.
So continue with your example. $100,000 loss, $50,000 can be deducted from your income.
Regular income.
Yes. To reduce your tax liability.
Yes, but if you lend it to someone that is just using it for whatever reason, as an investment, not a small business, then chances are you would not be able to claim it as allowable business investment loss. You will have to claim it as capital loss. Capital loss is still 50%, but capital loss can only be applied against capital gain that you make.
Okay.
So it gets complicated.
Okay. Speak to an accountant. But generally, though, the people that we see losing money in private lending, they're lending to real estate investors who
Sometimes
are flipping or doing BRRRRs or.
Yeah, sometimes people are using corporations,
businesses?
sometimes they're not, right? So.
If they're lending to a corporation or an individual, is that
that makes a difference.
That makes a big difference.
Yeah. Because a lot of them are doing it as an investment, right? So
right.
They're not doing business.
Right.
Yeah. So depending on the structure, and see if the corporation that you're lending to qualify, then you may be able to have another way, and which is a lot more beneficial, to be honest.
I would guess a lot of borrowers are using corporations. They would lend to corporations to protect their liability, protect their assets, protect their personal assets. Oh boy, this could all get really messy, more messy. And that's the other thing about private lending. I didn't want to take someone's house from them. That's great. You want to secure a second mortgage or a first mortgage or whatever on your home. I don't really want to take it away from somebody, which is why, again, like I don't want to get into this, right? Versus a lawyer that I met, for a meeting that we were doing, we borrowed a friend of a friend's lawyer office, and then I got to meet the lawyer owner of that practice, and we got talking about real estate and how she originates private mortgages. I go, oh, that's really interesting. What's the underlying security, right? She says, oh, these are like 100-unit apartment buildings by investors with like 30 years, 40 years track experience. Never lost money. I've never lost money type thing. Like, oh, fascinating. And they said, oh, how can I invest? She's like, first of all, if I like you, you have to have $1 million to invest. It's like, oh. Sorry. My point is that there's wonderful stuff out there available for private lending, from the surface level. It's not advice, obviously. From from the 30,000 foot view, it looks like a wonderful opportunity, but it's only available to the ultra wealthy.
Well, to put it another way, like these people would have bigger appetite for high risk stuff as well. Like they can risk to lose some of the money. And I'm pretty sure that they would not put the entire $1 million in that particular one property.
Correct.
It's probably over.
It'd be spread over multiple.
Yeah. So then, if you are able to afford to do that, like that's the easy way to diversify your risk. Lend it to different people, different borrower, to diversify
high
your risk. High
quality borrowers.
Exactly. So.
And that's the thing I don't think most people get. Like they'll look at someone's like Instagram, for example, and they'll like them, and that's enough risk analysis for them. I like them, and they'll lend to them. But we gotta move on. We got a lot of other things to cover. Is cottage rentals bigger than U.S. investing?
Well, they're both. I wouldn't say necessarily cottage. I think a lot of people are trying to do cottage and short-term
rental. Right.
Yeah.
Right. And so what are clients asking about in that area?
Short-term rental is tough. I mean, you and I did short-term rental in the past.
Yeah.
We try to do it passively, meaning that we hire a property manager to do it and
pay 20%.
Pay 20% and all that. But then if you really look at the numbers, I don't know if it is necessarily better than having straight rental.
Yeah, we shut it down.
Yeah. We shut it down, but like in general, I'm talking about in general. Now, a lot of the people have to understand that like having that short-term rental, a lot of the time means that you do have to handle the tenants on a regular basis. It's a real business.
Yeah, it's a business.
Yeah.
Like a hotel.
Yeah. So it also means is that it comes to a different type of tax implication, especially when we talk about selling the short-term rental. So a client of ours is considering buying this cottage rental that has been running as a short-term rental. And the seller is asking for HST on top.
Ooh.
So this is, I don't know the exact number. Let's say you buy the property for $1 million, and the seller is asking for HST on top. The reason why they're asking for HST on top is because they have been using the property for short-term rental, and short-term rental are primarily considered the rental period for less than 30 days. So when you do short-term rental and your property only does short-term rental, for sure your property is considered to be converted to commercial property. You're conducting commercial activity, and therefore you would have to, it's a commercial property. When you sell it, you will have to charge HST if the buyer is using it for personal use basis. If the buyer is also going to buy it as a short-term rental, they could sign the form and get registered for HST. They may already be registered for HST, and by providing the valid HST numbers to the lawyer at closing, you can get exempted from paying the HST as the buyer. But at some point, that property, if it's ever being converted back to a long-term residential or for you to use personally, then you have to pay the HST on fair market value at the time of conversion.
Damn, I wouldn't buy this.
Yeah, it's no different than like buying a unit at Dehurst Resort. For any of you who knows, Dehurst it's a resort place up in Huntsville.
It's a cottage-style resort. It has condos available for sale.
Exactly, and you can put your unit into a rental pool. And for those of you who put the unit into your rental pool and the hotel manage it and rent it out for you, they have to charge HST on the sale.
Is there a line in the sand? Maybe not. I shouldn't use that term. How much of the year does it have to be rented for it to be considered commercial? So,
see, this is a great question. This is the reason why I have to prepare this stack of paper. It's actually not an easy answer. So typically, a property is considered a residential complex in the eyes of the Excise Tax Act, provided that it's considered like, you live in it. It's a house. It's a house or a condo unit or townhouse, whatever.
Right.
Now, so there are typically, the rule is that it's always a residential complex. And so unless it's brand new, you don't need to charge HST on the resale value unless 3 conditions are all met. The first condition is that it's like a hotel. It's being run like a hotel. So what does that mean?
So Deerhurst, yeah.
So what does that mean by run like a hotel? Then that means
Regular housekeeping.
There is a common reception area.
Yeah.
That could be one of the conditions that they look at. You may not have a common registration area, but doesn't mean that it's not a hotel. It's always available for public to rent as short-term rental. Those are like some of the characteristics of a hotel. The second condition is that it is not used primarily as a place of residence. So it's not used primarily for someone as a long-term place to live in.
So it's not their primary home.
Yeah, so it's not 50%, more than 50%, not. So you have to, like, it's written in such a convoluted way, so then you have to go, like, not. So you're not hotel, you don't live in it for more than 50% of the time.
Yeah.
And then the last condition is that all or substantially all of the leases are for less than 60 days. So what's all or substantially all, meaning over 90% of the leases are for less than 60 days. So how do you prove that overnight than 90? How do you prove that your number is less than 90%? And this is on a...
Oh, sorry, just pause just a second. I hope all the midterm rental people are paying attention. 60 days is an important number.
Yeah, 60 days is actually specified in the act.
Right.
It's not me making up the number.
Right.
It gets a bit confusing because
most municipalities are saying 30 days is the cutoff between what's considered short term. But to appease disposition tax purposes, you need to be over 60 days.
Yeah, so then you don't have to charge HST on the sale of the property or
which is a big deal.
HST. Yes. Oh, absolutely.
Like the $1 million property example, that's $130,000 of HST.
I would argue that $1 million would be inclusive of HST, so you divide it by 1.13.
Right, but the seller's covering their ass by making it on top.
Yeah, that's exactly what the seller the seller is doing in the example.
No deal.
Yeah, but then we would have to advise our client, like, hey, like at some point, if you change the use, you have to carve out that whatever $100,000, $130,000
Right.
at some point.
Jeez, complicated.
It is complicated, but you may keep it as short-term rental forever, then you have no issue at all, or you don't care.
Interesting.
A lot of those resorts, even now in BC, they're selling it plus GST or plus HST, selling it as a set business, as a short-term rental business. So those are like, you have to look at it almost differently, even though there are exemptions. So
yeah, look at it like you're buying a business.
Yeah, exactly. So when you're buying a business, obviously HST is applicable.
Right.
But then you can get exempted from paying the HST.
Right. And I'm guessing this is like kind of like the Wild Wild West. Because, for example, I see it a lot there on social media. People are doing rental arbitrage. Say, for example, you were to rent a property you owned to a property manager who's going to then operate a short-term, middle-term rental business, put it on Airbnb, for example. So even though your lease is with the property manager, so it's probably like
Could
1
be
year.
residential lease, regular residential lease. Then you don't know what that person is doing. And if they turn around...
Oh, no, that's not the case, though. Everyone knows what they're doing.
No. Like, if I'm the landlord, I rent it to you. And then you turn around and realistically, if you turn around and rent it as on Airbnb, then how would I know?
All right.
How would I know?
Hope you're not suggesting something.
No, I'm just saying, like, that's the reality. And then how do you define it? Like, technically speaking, I would still have that same sort of liability, potentially. But I don't even know.
On disposition?
Yeah.
Oh, boy.
I could, but I don't know.
Yeah, we don't know. That's my point. That's my point. Is like this is kind of like Wild Wild West.
Yeah, it is.
Because, for example, I've spoken to a couple investors who are doing these strategies, and they do not have short-term rental insurance. They tell me that the property manager does. I'm like, this is kind of gray.
Yeah. So how do you enforce your property management is going to pay you? It's not
Exactly.
possible. Like for the damage.
Oh, I'll
it's
just
your
sue them.
damage.
Yeah, I'll just sue them. Like, oh, great. I'm trying to simplify my life. I don't need to sue more people.
So the Airbnb, like the short-term rental. So like I also got client who asked me about cottage. The same criteria apply. Actually, this literature is about the cottage. It's based on the cottage example.
Oh, okay, but the rule should apply to a condo apartment as it would to a cottage.
Exactly. Yeah.
Same as with the Deerhurst example that doesn't even have a kitchen. I don't know how you can argue residential and then there's no kitchen.
Well, there are units that has.
Yeah, some do. Yes.
Yeah.
Yeah. Interesting.
So
yeah.
people need to pay attention to these.
Pay
types of location.
attention, and then I would say is from the investment standpoint, like this can't be your only investment strategy for that property. Like you need to have multiple options.
Absolutely.
Right. Because if there's a chance that this one option will fail, since so many municipalities are banning short-term rentals, and then once all the short-term rentals go into medium-term rentals, then there's a chance there'll be too much supply, and then if you ever need to get out of that strategy, then what's Plan B? Right. Do what a lot of people we know are doing, trying to get people off of Airbnb and just renting their property directly. Yeah. All right. Anything else on cottage rentals? Anything else on short-term rentals? Are people making money with them? Is it profitable?
I think to some people they are. If they are hands-on, naturally it is profitable. You're earning the management
Good.
fee, right?
Good.
But if you're not hands-on, like how we operated before, it's harder to make money. Yeah, you're just escaping the landlord-tenant board control, but you're not necessarily making a lot of money.
Yes. We also had a much more expensive property than I hope most people do.
Yeah.
And also, we don't generate the rents like a cottage would. A friend of mine told me yesterday she paid $6,000 in rent for a week for a cottage. But like 1,000 square foot bungalow with a hot tub. $6,000.
We got a deal for our own.
We didn't get that kind of price. That's where we failed with our Airbnb.
I mean, we got a deal for our own cottage rental. We rent for sure.
But I would also add, like, I don't know how long this lasts. I think this is a bit of a vacation boom. I don't know if the boom continues, and also with so many people getting into it, will there be an oversupply of vacation properties? I don't know, but I see risks. I see risks everywhere. Yeah. There's opportunity as well, potential opportunity. I'm not saying no to it, just be aware of it. Now, U.S. So, why are people speaking to you about U.S. properties?
They're our clients. Then they're looking to get cottage. They're looking into investing in the U.S. And we got lots of clients because they got sold to these properties because they are supposedly providing a lot of return, cash on cash return.
Okay. Hopefully
high
they're
rent, no rent control.
Right.
Everything is better.
Hurricane free?
Some of them are investing in Detroit. So there is
okay.
Yeah, so not necessarily all in Florida.
Okay. Texas?
Some of them, in Texas as well.
Right.
Yeah, Dallas.
Right. I know clients and friends of mine, they got whacked in Coral. What is it?
Cape Coral.
Cape Coral? Yeah, very sad. And yeah, and I was sharing with you before we were recording, like I was reading in The Economist this morning, the advice that insurance adjusters are giving hurricane victims is photos are everything. Get your claims ASAP because some insurers are going under. Right? Some insurers will go bankrupt, and then I don't think they get paid. And then to add to that, the fastest growing insurance provider in Florida, and they also have the highest market share, is a state-backed insurance company. So meaning it's a government insurance company is the fastest growing. So that's just to me, this is fear. Private industry doesn't want to insure these properties, right? This is Florida. It's supposed to be like, the home of capitalism. Here we have a state-backed insurance company.
So, like I personally would consider having a U.S. property, but after I crunch in the number, the biggest challenge that I see that people don't usually mention is the foreign currency exchange rate risk.
Yeah.
I think we were on our way to Orlando to a marketing conference, and sitting next to me was this lady who's also a realtor, a local Oakville realtor, and she bought this property in Florida, which is around $350,000 market, detached house in a gated community. And I was spending the whole 3-hour flight talking to her about this property. And she shared with me the number, like it could be rented for $2,700 a month, and property management is about 10%, so $270 a month, which is all great. But then when I come back and crunch in the number, the biggest challenge that I have is the foreign exchange currency risk. On paper, it looks great, but then because of how the U.S. dollar has gone up in relation to the Canadian dollars, the U.S. dollar has to stay at that point for me to make money. So what I mean is that back in 2008, basically the U.S. dollar is on par with the Canadian dollars. If at that point in time you just buy a property in the U.S., which was also the best time to buy, even if it doesn't go up in value, just by holding onto the property and you sell it today, the property would have gone up. The conversion of the the U.S. dollar has risen for like now 1.4 to Canadian.
There, somewhere around there, yeah.
So even if the property value doesn't go up in value,
yeah, you made it on the FX.
You make all your money in FX, which contrary to today's market, you're paying 1.4. The market,
getting in now is terrible.
Getting in right now, people don't talk about that 1.4 conversion, which makes me worry because, it's realistic. Are you going to not spend your money in Canada? Are you not going to retire in Canada? Yeah. What are your long-term plans with owning that property?
Yeah. Being able to earn income in US dollars is great.
Yes, absolutely.
But if I'm investing right now, I'm probably buying Canadian stuff.
Yeah.
Because my dollar goes further.
Yeah, so people don't talk about that 40% conversion. So you have to pay 40% more. So that means in the future, if the dollar goes down against the Canadian dollars, the US dollars goes down, then the property has to go up in value big enough to cover your foreign currency loss. So I hope people actually understand what I'm talking about.
I think they do. People, I think Canadians are, especially our audience, will understand cross-border shopping.
Yeah.
You go cross-border shopping, you go to Buffalo when the dollar's closer, when our Canadian dollar is strong. It is not strong at all right now.
Yes.
The US dollar is incredibly strong. It's been one of the best investments of the year.
Yeah, exactly. So then you have to understand that
it's not good value to go buying American stuff.
Yeah, I'm not trying to say you shouldn't do it. You just need to account for the potential that the dollar is going to go down and the house, it's just another variable that you can't control.
Yeah, but even if you put yourself in the American shoes, you have a super strong dollar. They're probably coming when we were in Niagara Falls just the last month, there were tons of Americans who were in Canada because their dollar is so strong. It makes sense for them to go the other way. Anyways, but yes. Foreign exchange rates risk, it's a big mountain to climb if you're going to buy today.
Yeah. And then the other thing that people don't always talk about is the cost of compliance and cost of setting up a structure. So I got clients who come to us and say we should set up all these corporations, or I talked to this lawyer in this particular state and they said that I should set up an LLC to own these properties.
Sorry, what's LLC stand for?
So I think LLC stands for Limited Liability Corporation, but LLC is actually kind of like a flow-through structure. So it just provides limited liability protection to the person who owns that LLC, but essentially, ultimately, it's a person who owns the LLC that reports the income and expenses. It's a flow-through entity.
Right, and then where is it based? Where is that entity based?
It could
Here
be in
or
any
US?
state
Okay,
in the States, because it's a tax filing status.
Right.
Let's put it that way.
It has to be in a state. It can't just be in the country of US.
It's a tax filing status. It's not something that you create. You elect to the IRS that you're filing as LLC. Anyway, the point is, with that LLC, CRA doesn't recognize LLC.
Oh, great.
And so LLC is being recognized as corporation in the CRA's eyes because it has many attributes of a regular corporation. So when you file taxes in
so
the
kind of
States,
coming together two different tax laws.
Structure, yes.
Right.
So then in the US, you file as if you are owning the property in your personal name. In Canada, you're filing because you need to file both sides of taxes. In Canada, your personal name, CRA is considering that LLC as a corporation. So now you have a foreign corporation. Now, if you pay tax on the US side, under perfect integration, both sides, the Canadian government would give you credit for what you actually pay in the US. But because you have this LLC set up, the government doesn't recognize it. So you pay tax in the corporation. In the US, you pay the tax under the LLC, under personal name. Over here in Canada, you don't get recognized for the tax that you pay. So any money you drew out from the LLC, it would be taxed again in your personal name in the Canadian side. So you pay double tax. And so like the biggest mistake that I've seen is that, hey, like if you do that, you just work with a lawyer, random lawyer in the States, they may offer you certain type of deal. It would only be applicable, those structure would only be applicable to the people who are located locally in the States. They're not necessarily applicable to people who invest from Canada.
Crazy.
And then when we when we put forth a plan that would avoid double taxation, it's often very complicated and clients do not like it. And clients do not understand it. And then clients don't want to pay for it. And clients also didn't understand that they have to set up like 3-4 entities in order to achieve that objective of not paying double taxation. They don't take into account the potential cost of filing. That's what I'm trying to say. And they're surprised by like, hey, I have to file taxes for 3 entities for this much money. And on top of that, your Canadian side has reporting as well, responsibility as well. So it gets like super complicated. If you're buying a single family rental, it gets really complicated on one side, on the other side.
So it sounds like to me you need some scale for this to make sense.
For the structure, yeah.
And also you need to be able to make so much money to cover this foreign exchange risk.
Yes.
I'm not highly motivated to invest in the US.
Well, I feel like we have gone through so many negative things. Maybe you can talk a little bit about the positive things.
I honestly don't know. We're heading to a recession.
Yeah.
There's going to be at least two more increases in interest rates in the US, maybe more. Like right now, not motivated at all. Right?
So are you suggesting to the audience do nothing?
I can't see, like even for cross-border shopping, it doesn't make any sense right now. Right? I'd probably wait until I have more clarity on where things are.
So don't do private lending, don't do cottage short-term rental, and then don't do...
I think they're all fine. Just the investment has to be quality, right? My challenge is I just see too many people do not know how to judge quality and risk.
So then how do they learn how to judge?
Kind of like the whole reason why I put on the conference. Okay. Best practices from experts, right? We're down on our crypto. We have the leading Canadian expert on cryptocurrency. And Jordan's going to be telling us exactly what and when he's going to be buying, right? These are things I ask them for all our speakers to say, right? Same thing with Derek Foster. I asked him to share, what are you buying and when are you going to do it, right? And how much, right? He's going to be sharing these things at the conference. You and I, we've seen some horrible things happen in real estate. We're sharing what didn't work and, what we think will work going forward and where we're going to put our own money going forward. Because I still believe next 18 months, 2 years, is our generation's chance to build significant wealth. This is the time. This is the time we've all been waiting for. This is our Great Recession of 2008, 2009. This is the repeat of that opportunity. And this is just a repeat. This is just a cycle, right?
Great.
Yeah, wealthhacker.ca if anyone wants more information. Cherry, any final words you want to leave off with? Bigger does not necessarily mean better.
Yeah, so like I've gone to multiple conferences and all they like to talk about, by no means I'm just talking about real estate investors, but I've gone through all these conferences, even the one that we went to, Orlando.
Yeah, we went to marketing conferences.
Yeah, it's marketing conferences. People always talk about gross revenue. They talk about like I sold $1 million US using a one funnel.
Right.
It's $2 million. By no means it's a bad number. It's like great number. It's number that people are striving to get to. But I just wanted to reiterate, and which is also the purpose of our conference, is that bigger is not necessarily better.
Right.
And I just wanted to remind, using my little voice to remind people, if you want to listen, that, you know, whatever you're investing is just a means to an end. And don't forget your end or your initial reason to invest. For us, it's to provide a secure financial future to our kids, as well as having the financial freedom or just freedom on its own. So, like, is it going to be real estate? Can it be something else? Or is it just purely real estate? I don't know.
Yeah.
I'm still learning. I'm still trying to figure out that solution. And I mean, I'm hoping to be able to present that at the conference, a message to you, to everyone. But at the end of the day, it's a mean to an end.
Yeah.
Bigger is not better. So I could be owning $200, but I could be negative cash flow $100,000 a month.
That's
you
hardly
wouldn't know
freedom.
that.
Yeah.
So just keep in mind that bigger isn't always better.
Yeah. Higher returns is not necessarily better.
And chasing the shiny object can be that shiny object could mean running a marathon. That shiny object could mean doing different things with your kids as well.
Yeah. And the portfolio, just because you and I have been talking about that we need to shift more of our investing towards cash flow. We've been so focused on growth and wealth, which has worked out great, but it doesn't necessarily give you freedom. So hence our shift to more generating yield. And then that's, again, something that's going to be covered at the conference.
Yes, absolutely.
The how-to. The what and the when and details.
Yes.
With as little risk as possible.
And then never lose sight of your own why.
Yeah. Amazing. Thank you, Cherry.
Thanks for having me. Don't forget to subscribe to my YouTube channel.
What's it called?
It's called youtube.com/real estate tax tips.
Amazing. Thank you.
Thanks.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. That link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.